Okay, picking up with figure 8.4.3, we noted that the rolling standard deviations were fairly stable until the onset of the pandemic, and then we got sizable changes in returns versus dollar change. Skewness is the third moment, our normalized third moment, if we divide by the standard deviation cubed. And categorizing skewness, generally if skewness is below -1 or above +1, it's referred to as being highly skewed. Between 1 and a half, -1 or to -0.5, or half to +1, it's moderately skewed. And if it's within a half, plus or minus, then it's approximately symmetric. Now, the interesting thing to notice is a positive skew. The log normal distribution, as we've seen in prior modules, assumes that distributions are positively skewed. And the diagram looks something like this. Many stocks are actually negatively skewed. When negative information comes out, prices tend to spike down. If positive news comes out of a similar fashion, they don't tend to spike up as much. And so that's typically the finance argument for why we observe so much negative skewness in financial markets. The key thing to notice about rolling skewness is that it is very unstable. It jumps around a lot, just depending on single outcomes that come in and out of the data sets. And so sometimes skewness is positive, sometimes skewness is negative. And there is a difference between continuously compounded returns, discretely compounded returns, and dollar changes. But generally they move in the same direction. Kurtosis is the fourth moment. If we normalize by the standard deviation raised to the fourth and subtract 3, because the normal distribution has a kurtosis of 3, it's referred to as excess kurtosis. And the sample calculations are given here. Very easy to program up or to use canned packages to do these computations. If the kurtosis is close to 0, it's referred to as mesokurtic. The normal distribution, binomial distribution, typically is mesokurtic. Leptokurtic is when you have sharper peaks and fatter tails. The log normal distribution. Most empirical finance data is leptokurtic, and the alternative is plateaukurtic, which is flatter peaks, thinner tails. Uniform distribution is an example. And so what we see here is the kurtosis, again, that has it spikes up and down depending on different singular outcomes. And during the onset of the pandemic, we got some sizable changes. And the thing to notice is that it's always positive. And if you recall, that leptokurtic means it's sharper peaks, fatter tails. Generally, financial data has more extreme outcomes than what is warranted with something like the normal distribution. And so this is a unique aspect of financial data. Typically it is leptokurtic. And so if we apply static risk measures, if we recall in the valuation work that we did previously, that we could model the valuation of a financial instrument based on the forward rates as well as the growth rates. And here we have a 4-parameter distribution, the level and slope of the discount rate, the level and slope of the growth curve. And there's an enormous amount of analysis that could be done within this context with static risk measures within the framework of the LSC model. And this is illustrated with R code in this particular module. We run the calculations that we illustrated before and are able to compute the sensitivities, the first derivatives with respect to a variety of different parameters, and do different analysis. The key insight here is that you get different sensitivities to different sectors and sector ETFs. And again, if our goal is to manage, say, a sensitivity to changes in the level of the base curve, have different sensitivities for different sectors. And so this could be a benefit in trying to manage risk, particularly within an asset liability management context. The R code provided can contrast different stocks. For example, we'll do a quick study of Wendy's versus McDonald's. We'll do a detailed analysis of holding period returns, and we'll highlight a few things that can be discerned between when comparing statistics of various companies. So the first thing we observe here is the normalized price between Wendy's and McDonald's, and my conclusion is you really can't tell a difference. Sometimes Wendy's does better than McDonald's, other times McDonald's does better than Wendy's. It's they all tend to move with the fast food industry. Clearly, when we compare the means, the continuously compounded means between Wendy's and McDonald's, it's just extremely difficult to predict which will be higher than the other. They bounce around quite a bit. When we examine the standard deviation, however, a completely different picture emerges. And so what we see here is clearly Wendy's has a higher standard deviation than McDonald's, I believe, in every single case. And so if we look at the difference between Wendy's less McDonald's, what we observe is that the difference in the standard deviations is always positive. And so this turns out to be very important, that the standard deviation is a much more consistent parameter when it comes to financial data when compared to the mean or higher order movements like skewness and kurtosis. For example, if you look at the difference between the rolling skewness, it's just between Wendy's and McDonald's, it bounces all over the place between positive and negative. If you compare that to the rolling standard deviation in figure 11, you see it's much more consistently positive. And so it is reasonable that we can conclude that Wendy's, when measured with standard deviation, is a more risky stock than McDonald's. But with regard to which one has higher or lower skewness, it's not clear. Which one has a higher or lower mean, at least based on historical data, again, it's not clear. And then when we turn to kurtosis, we get the same sort of result. When we look at the difference between Wendy's and McDonald's on rolling kurtosis, it's just extremely difficult to predict that how they differ. So in summary, we explored the static risk measures, applications with various stock valuation models. We reviewed technical details of return calculations. We identified sample statistics and a related R code. And that concludes our study of bonds and stocks on static risk measures. In the next chapter 8, we'll turn to options and look at a variety of static risk measures. This is the more traditional delta, gamma, theta kind of calculations that you may or may not be familiar with. So I'll see you again in chapter 8.